Welcome back to Straight Money Strategies. I'm Robert Bauman, and this course is based on my book, Straight Money Talk. Lesson 7. Why you should invest with a professional manager. Once you make the decision to start saving and investing, one of the things you'll have to decide is where to put your money. You want to be sure you're getting a good rate of return, but you also want to be sure you don't lose any of your savings. Many beginning investors realize they don't know how to do this. They don't know how to get started with investing, and they don't know where to get help. So, in this lesson, I'm going to discuss how to invest your money wisely. In particular, I'm going to talk about some of the mistakes novice investors make and how to avoid those mistakes. I'm going to talk about how a financial professional can help you invest your money, and about how to use managed funds as an investment vehicle. First, let me talk about some things you don't want to do. Many novice investors simply leave their money in a savings account. They do this because that's all they know. A savings account is definitely a safe place to put your money because it can never lose value sitting there. But it's usually not a wise investment because the interest is so low. Sometimes the interest on savings accounts is lower than the inflation rate, meaning you're actually losing purchasing power. So a savings account is definitely not the best alternative. Some novice investors want to put their money in stocks because they understand that the stock market can offer great returns. While it's true that many investors make money buying and selling stock, it's also possible to lose money. Not only that, but investing in the stock market requires you to be diligent and to carefully research and monitor companies. Also, you have to know how to time the market. To show you what I mean, let's look at some historical data from two of Australia's top companies. The first company I want to show you is BHP Billiton, the Petroleum and Natural Resources Company. If you had bought shares in BHP in 2003, your investment would have grown nicely over the next 8 years. Between February 1st, 2003 and July 4th, 2011, BHP earned a return of 472%. That means that you invested $10,000 in BHP on February 1st, 2003. That $10,000 would have grown to be worth $47,241 on July 4th, 2011. That's an excellent return, and you would be hard-pressed to do better. Now, let's compare that with the performance of Telstra, the telecommunications company. Telstra stock closed at $4.41 on February 1st, 2003, but was worth only $2.84 on July 4th, 2011. That's a loss of more than 64%. That means if you had invested $10,000 in Telstra on February 1st, 2003, you would have had only $6,439 on July 4th, 2011. Obviously, no one wants to see their hard-earned money disappear that way. Another reason investing in the stock market is challenging for beginners is that it takes a great deal of research. Ideally, you should review the company's performance history. You should know something about its top management and understand its business model. You should look for companies with a history of strong earnings, high profit margins, and low debt. This type of research takes time, and even then there's no guarantee that your investment will pay off. Then, once you own stock, you have to be diligent enough to keep track of what the companies in your portfolio are doing. You should be following earnings reports, reading news stories, and monitoring changes in the economy that might affect your company's performance. Many people just don't have the time or the interest to do this. Investing in the stock market is difficult for some additional reasons. You have to be good at timing the market. You have to know when to buy and when to sell. You have to be prepared to stay in the market for a long time, which means you also have to be comfortable holding onto a stock that has lost value and waiting until the price of that stock goes back up. In other words, sometimes stock investing requires you to behave in ways that seem counterintuitive. For example, the best time to buy a stock is when it's undervalued and its price is low. But novice investors often wait to buy until there's a buzz in the media about a company or until the stock has grown in value. That's usually too late. By the time people are talking about a stock, the serious investors have already made their money and there's not as much potential for growth. Similarly, novice investors are quick to sell a stock when it falls in value, but seasoned investors know to hold on and sometimes even to buy more. They know that a good company whose stock has temporarily fallen in price is often an excellent value. What I'm saying is this: when it comes to investing, there is a great deal you have to know and there's a great deal at stake. Fortunately, there are financial professionals who can come to your rescue. Stockbrokers and financial planners are two kinds of professionals who can assist you by designing a portfolio that can meet your exact needs. These professionals are familiar with investment opportunities you probably don't know about, and they have the training and experience to guide you through the challenging world of investments. Also, they can keep an eye on your portfolio and recommend changes in your investment strategy as the economic climate changes. Another option is a managed fund. Managed funds put your money together with that of thousands of other investors. The professional manager then invests this giant pool of money, buying stocks and other assets based on his knowledge and experience. With a managed fund, you don't have to research a lot of companies or stay on top of what's happening in the stock market. The fund manager does this for you. You simply have to select a fund whose performance is good and whose objectives match your own. The fund manager does the rest. Putting your money in a managed fund, then, is another way of letting a professional help you with investing. Different funds have different objectives. Some funds are conservative in their approach to investing, while others are dedicated to high growth. This chart shows how different funds might invest money in different ways. A fund with a conservative objective might keep a high percentage of its money as cash and place very little in foreign stocks or real estate. A fund designed to offer high growth, on the other hand, might keep very little money sitting around as cash and would likely make riskier investments. Managed funds have many advantages. The first advantage, as we've already mentioned, is professional management. Your money is invested by a professional, someone who has expertise in financial analysis and stock selection. They do the hard work so you don't have to. Another advantage is diversification. Because managed funds allow you to pool your resources with other investors. You can invest in a wider range of assets than you can by yourself. This pooling of resources also limits your exposure to a potentially risky investment. The third advantage is how easy it is to invest. As we've seen, when you put your money in a managed fund, you don't have to do as much research. Yet, your dollars are being used to purchase stocks and other worthwhile financial vehicles. You reap the financial benefits without having to do as much work. In addition, managed funds make it easy for you to invest in yourself first because they often allow you to set up weekly or monthly automatic contributions. Besides all of this, managed funds let you choose how you want to invest. You can invest for income by choosing a fund that focuses on distributions, where you can choose a fund whose focus is capital growth. You can even select a fund that has several objectives. There are many kinds of funds to choose from. You only have to decide your investment goals and select a fund that matches those goals. Here are some additional advantages of managed funds. Many managed funds have a low minimum investment. That means you can often start investing with as little as $1,000. And because that $1,000 is being invested in the fund's broad range of assets, you will get a wider distribution of investments than you would if you invested a small amount of money on your own. Another advantage is liquidity. Managed funds let you access your money anytime by simply selling your shares. You don't have to try to time your sales to suit the market the way you do when you hold individual stocks. One more advantage is the possibility of an income stream at retirement. Investing in a pension or annuity today can give you a monthly check when you retire. These products also offer significant tax advantages. Your financial professional can explain how they work. In addition to all of this, managed funds allow for easy tracking. It's simple to monitor the performance of most managed funds. Often it's as easy as logging onto the internet and taking a look at your balance. Your financial professional can show you how to do it. There are so many reasons why managed funds are the perfect investment vehicle to help you build wealth. Just be sure to keep these key points in mind. Choose funds that match your investment strategy and that give you a good return based on the amount of risk you're willing to take. Some managed funds do well and some don't. Always review the long-term growth of any fund you're considering. Let a professional financial planner help you find the managed fund that works best for you. This brings us to the end of Lesson 7. Once again, it's time for you to take action. Click the tab marked Resources above and download the Lesson 7 study guide. Answer the questions and complete the required action steps. For this lesson, the action steps require you to talk with a financial professional and to identify at least one managed fund that might be right for you. Once you've completed that step, you'll be ready to move on to Lesson 8. in Lesson 8. We'll show you how to manage your mortgage payments so you pay less overall and keep more of your hard-earned dollars. See you in Lesson 8.